We are in topic 6, dealing with payroll, and you've seen now a couple videos and answered some questions regarding typical payroll deductions. On your screen, you see a page from the General Journal for the Mountain Ski Shop, and we're going to use this example here to show how that information about payroll deductions ends up in the two books of the business. Once again, if you know the basics of journalizing and posting, this is not all that difficult. Sometimes it can be a little more complicated when we figure the actual numbers, the amounts of money for the deductions for the employees. But at this point, we're not ready for that, and I'll simply be giving you some numbers to use, and we'll plug them into our journal entry and then do some posting. So first of all, we're going to do an example here, and then you'll have a problem to do on your own. So let's take a look at what we're given here on the right. This is the monthly payroll information for January 31st, 2020. So we're jumping ahead a few months, and we're at the beginning of the year, and we'll explain why we're doing that using January a little later. But let's assume that it is the end of the month of January, and this company, the Mountain Ski Shop, pays its employees once every month. It makes it a little simpler for us. You can see as we go through this, if we pay the employees every week, it takes much more time, and people need to be spending a great deal of time with payroll deductions, figuring them out accurately for the employees, and then putting them into the books of the business. So we'll make it simple, and we're going to be paying these people once a month. So the gross monthly salaries for the employees for the month of January is $24,000. Now, you know, in previous problems you had prior to this topic, the journal entry was pretty simple. You debited salary expense because this was cost of doing business, so that would be debited, and expense is debited when it increases, and cash is credited because money was going out of the business. Cash is an asset, goes down on the credit side. So a debit to salary is expense, a credit to cash. Now we're getting more complicated. The employees have earned $24,000, so we're committed to that amount of money for them. But they won't get that much in their paycheck. They'll get a lesser amount in their paycheck, as we'll see. So that's important. We have 3 deductions. Now, there could be, as you've learned, there could be more, but we have 3 basic ones here. We are deducting from the employees amount of money for federal income tax. It's withheld from their paychecks. We are withholding $6,000. It's their money. Now, you need to understand how that concept works. This is not our money. They earned it, but we take it away from them by law and hold it for payment later on their behalf. So this is the federal income tax that they will have to pay. We are withholding it, and we'll pay it to the federal government for them later. Same way with state. The state income tax as withheld from the employees is $4,500, and once again, that amount of money is required by law and will vary from state to state. But we are withholding it from the employees and will pay for them to the state later on. And finally, FICA is withheld from the employees. As you know, this encompasses 2 big areas, Social Security and Medicare. And again, these are federal programs and are required by law to be withheld from our employees, and that amounts to $2,000. So let's take a look at the journal entry. This would be, whoops, we're looking at 2020, and the debit still is salaries expense, and it would be for $24,000. And there are several credits now, as we will see, and this entry is longer than the ones that you're used to. The first credit would be to an account called Federal Income Tax Payable, and it is a liability account. And as I think I mentioned earlier, this is an exception to the rule. This is called a liability, even though we don't get an asset in return. GAAP, Generally Accepted Accounting Principles, says that this still is to be considered a liability. Business does have to pay it. It's the employee's money. We'll have to pay it on their behalf later, but we don't get an asset in return. But again, it is a payable, which means a liability. So the credit is $6,000. The next one is done similarly. State income tax payable, and the credit here is $4,500. And again, that means it's increased, and we owe more money now to the state on behalf of the employees. And finally, we have the last liability account. Taken out of or withheld from the employees' paychecks in the amount of $2,000. Now, there's one more credit to this entry. The last credit goes to cash, and this is the net pay that we will end up paying to the employees. We're not sure how many employees we have by the information we're given, but the total amount given to the employees on their paychecks will add up to $11,500. And it has to be $11,500 because the total of all the credits, including the cash, must equal $24,000, which is the debit. Debits must always equal credits. So typically, you know these three numbers. You add them up, subtract from $24,000, you get $11,500. That's the net pay. Okay. So that's our explanation, if I could spell it right. We issue payroll checks, which are different kinds of checks from our normal checking account, but the money does come from the cash account of the business, so that's why cash is credited. So that's our journal entry. The second part of this process is posting, and we've done a lot of that, and as you've discovered, hopefully, it's a pretty simple process. We simply look at what is done in the journal and transfer it to the ledger. So the first part of the entry is a debit to salaries expense, and if we go to our ledger down at the bottom, looking at the tabs, we find salary expense. Whoops. I keep forgetting we're using 2020, and we're debiting $24,000. The reference is the page number back in the journal, which is page 15. So it would be J15. The account is 504, and that goes into the journal. And again, as we've said earlier, at the end of the accounting period, expenses have a zero balance, as does revenue, and we now are putting something into one of the expenses. So that expense has now money into it because of this journal entry. Let's do just one more to make sure you see how this works. Federal income tax payable is a liability now. It's credited by $6,000, so it goes up. So in the liability account, we find federal income tax payable. And again, this came from journal page 15, and it is a credit of $6,000. So we now owe $6,000. And if we continue the posting, there'll be money on the credit side of state income tax payable, and there'll be money on the credit side of FICA tax payable. These become liabilities, just like this is a liability in accounts payable. We owe it, and we will not be paying it immediately. Typically, these kinds of liabilities for the payroll taxes are paid quarterly, which means every 3 months. So we owe now $6,000 for federal income tax payable, and the account number is 202. Back into the journal. We do the same thing with the state and the FICA, as I said, and these two accounts are credited because they're credited in the journal entry. And finally, cash is credited in its asset account, which reduces the balance. So if we look at that from J15, the credit of 11.5 obviously reduces the balance in the cash account because we're paying money out, and we would do this every month. So that would be the process. And then once again, as I said earlier, if you understand how to journalize it, the posting is pretty simple. Now, at this point, I would ask you to go back to your course page and look at a problem that follows.